we go. If you remember, this is Canongate Apartments. Again, this information is, this is how I look at properties, and these are the kind of properties, like Raphael said earlier, you know, he's looking for properties that really can throw off a good cash flow. And that's what I'm looking for right now too, especially. Not so much the value adds, because if you listen to a broker, they'll tell you everything's a value add nowadays. This was not identified as a value add. This is just strictly a cash flow issue from a buyer's perspective. But again, I'm not a lawyer. I'm not soliciting funds. This is no longer a property that we have. It's not under contract. It's now off market, and I'll tell you why. It's located in Vicksburg on the Mississippi River in about central Mississippi. It's an 80-unit complex. It's sitting, as you can tell, it's sitting on a small hill, several miles inland to the east from the Mississippi River. And the nice thing about that is, because it's up on a hill, it's not in a flood zone. And if you've ever seen the Mississippi flood, sometimes it can flood for miles in every direction inland. The asking price was $6 million, if you remember. Pricing guidance I got going in from the broker was $5.5 million. And you can see they've had some good vacancy rates there. What was driving Vicksburg and why we're seeing good vacancy rates? The rents on this property were a little bit higher than the city average, and the reason being is it's one of the nicer properties in the Vicksburg area. And the people who are affiliated with the Army Corps of Engineers and the nuclear power plant just up the river from Vicksburg, the engineers and stuff were living in this property. So I had a little bit higher grade of client living in this property than there may have been in other complexes around Vicksburg. Allegedly, the owner was looking to reposition their money in their portfolio and get out of what they would call this smaller property and allow them to have more of a war chest to get into larger properties elsewhere. Underwriting assumptions, I try to be very conservative because of COVID at the time. We were just going into COVID. We didn't know, how things were going to shake out. And ultimately, we put in a bunch of circuit breakers that would trip us from underwriting to be aggressive at all. We did underwrite. I got a loan sheet from a broker at 25% down instead of 30 or 35% like I had originally written. And the term sheet was for 3.15%, which floored me for Vicksburg, Mississippi. I mean, Vicksburg is not a big metropolitan area, but I used 3.75% for my underwriting, and then 1 year of IO that was offered by the Fannie Mae in this case. You can see some of these others. I did up the overall economic and physical vacancy to 12.5% for the first year, 10% for all the years following, even though the property was experiencing right around 5% combined physical and economic vacancy. No rent increases for the first 2 years, and then a simple 2% escalator for years 3 through 10, and expenses the same escalation. We did include 1 year principal and interest payments for reserves, because that's what Fannie was reflecting at that time. 1 year in taxes, 1 year in insurance, also in reserves. And we were looking at a 65-35 split. If you were there on the January meeting, you heard another investor say he would never invest in something that was at least 70-30. Okay. But when you see some of the potential returns in this property, you can see why we went 65-35. Our operational plan for the property was to keep the rent stable. For the first 2 years, especially, let COVID run its course. We went with 1 year interest-only payment so we could maximize cash flow during this uncertain time. The key here was cash flow. If you've got cash flow, you can weather a lot of different storms. And then payroll was extraordinarily high. The property manager that I had selected to work with us on this property was originally part of the company that built this property. And then he ran it for the original builders until they sold it to these existing folks. So he was well aware of the city, he was well aware of the property, and he was well aware that some of their expenses had gotten out of line. So we could save $40-some thousand right off the bat just by buying the property. And on an 80-unit property, that starts to affect your returns pretty quick. We were not going to refi during the term. We were going to increase principal pay down through the whole 10-year term to try to increase returns back to the investor. I've got to move you guys a little bit here because you're covering up some of the things I wanted to talk about. Oh, there we go. Again, asking was 6. I originally went back to them with a $4.5 million offer. While they didn't agree with that, they didn't throw me out of the room either. They came down to $5.5 million, which was some of the guidance from the broker. I came back at $5 million. They came back at $5.2 million, and I said, sure, let's go with that. So we had a verbal. And then I set the LOI in, and the LOI just sat, and it sat, and it sat. And I'll get into that story in a minute. But you can see here then all the information that I just talked about, the 12% total, 12.5% between physical vacancy and economic vacancy. But the average cash on cash to the investor was north of 8%. Debt coverage ratio in the first year was 2.4%. So you know this thing's throwing off a lot of cash. And the overall annual return, average annual return to the investor was just under 18% projected. So what was my exit strategy? You know, you never want to buy until you know how you're going to get rid of the property, if you're going to get rid of it. So I had some options, especially with things being uncertain with the virus and with the stock market at that time. If you remember, in March, the stock market was vacillating hellaciously. It was going up and down like crazy. And we don't know even still how that's going to stabilize out and what it's going to look like for the next several years. So I was looking at a 10-year hold and reevaluate the market during that time. Then I could either refi at the end of the 10-year term and return the rest of the capital for a tax-free event to the investors and then hold it longer, or I could sell to another syndicator much like myself. And I was projecting selling at $7 million, and I'm looking to buy this at $5.2 million. So not only are we going to get cash flow, and you'll see what that looks like in a minute, but we're going to get $1.8 million in additional equity. Part of that is because we were paying down principal and interest for 9 of those 10 years. And then we could always take that profit. So those are the two options I had as far as exit was concerned. I would have preferred to do the first one, which is refi and hang on to the property if it's going to continue to throw off tons of cash. So here's what those investment returns would look like. This is combined cash flow for the property operation. If you see here, we're going to have to raise about a little over $1.7 million. 329 of that is in the additional bank reserves that you can see here. Can you follow my cursor here? Is that visible to everyone? Okay. Total cash flow, this is a beast when it comes to cash flow. This first year of 12.5% is because of the interest only. But even then, for the second year, when we start principal and interest payments, it would have been close to 9%, over 8.5%, and then just goes up from there. So the average cash on cash return overall, you can see how it continues to go up over time. And the average annual return does the same thing because and that includes the equity pay down. So what would this property have supposedly provided? Well, if you look at these return numbers here, the average annual return just on a cash flow play at the price that we agreed to would have been well over 25%. The projections here are 28.69%. Who knows if it's going to be exactly that? You never know what's going to happen, but this is a hell of a cash flow or average annual return just based on a cash flow play. And the average cash on cash return just under 14%. Those are some outstanding returns. That's why you say don't fall in love with a deal. I didn't. I fell in love with these numbers. And so I was happy. I had lined up the loan sponsor. We had the funding lined up. We had the loan quote from Fannie Mae. I had the property manager. So what happened? Let me stop sharing. That LOI sat there and sat there and sat there. And I wound up talking to the person who's going to raise the money and to the loan sponsor. And they said, well, you know, your offer has expired. Let's go back at a slightly lower offer, which we did. Finally got the broker to answer back. He said they pulled the property off the market.
You shopped your deal?
What's that?
Did they shop your deal?
Well, they weren't going to sell it because they didn't sign the LOI and we didn't have a purchase and sale agreement. They can do whatever they want. And apparently they were just shopping the deal. Yeah. I had the highest price. I know that because the broker told me that. But for some reason, the guy who was doing the negotiating with the broker had represented himself as the majority partner in the company that owned the property. When a push came to shove, and he said, and I've got no problem with convincing the minority owners that this will be a good sale. Well, when we finally got pushed to shove and we gave him the price that he negotiated, it turns out he was a 1% owner in the property overall. He was a minority owner. So what the hell he was, excuse my language, but what the heck he was doing, I don't know, negotiating for everybody. But apparently they were just, it turns out, I believe, shopping the property to see what they could get from it. Pulled it because maybe they didn't like some of the terms that were going to happen from, you know, the COVID, and they wanted to wait and see. So I'm keeping my eye on this property. I don't know that I'm going to get it at 5.2 million again, but you know, if they want 5.5 million, I'm going to go back after it. But these are the things that, you know, you heard Raphael talk about all the different ways that he had trouble getting properties. This is another one where you think you come to an agreement, you have a verbal agreement, everybody knows that 5.2 is the number, and then they just say, thanks, but no thanks. Try us again at a later time. So, but what's important is that you go through this process. You know, you learn how to get your team pulled together, and you work with the brokers, you work with the rest of your team, and you know, put the best picture forward that you can. You're not always going to get the deals. I would love to have this deal because obviously these returns are crazy. And just think about if you can do any additional value add on top of it, you're driving things through the roof. This was a home run. I mean, the property was going to give back not only all the initial investment, but another 2.5 times. They were going to get over $4 million overall property performance for a $1.7 million investment. Unbelievable. So these do happen. They come up from time to time, but you got to be out there looking. You're gonna be able to, as you do that, you're gonna wind up having your own stories to tell about. Darn, the one that got away. Ouch, this one hurts. But since I brought it up to you guys in January, I wanted to make sure to follow up with you and let you know what ultimately was happening with this property. I've got it on my desktop. I'm not getting rid of it because if it comes back up for sale again, I want to be taking another look at it. But just to keep you informed, this is an interesting time to be buying properties.
Quick question.
Sure.
Do you file everything that you underwrite?
Yeah. If I actually underwrite it, I file it.
Okay, in case you got to come back to it.
Well, and it's important because there was a property in New Jersey I was looking at, in southern New Jersey, over in Blackwood. And, you know, I originally looked at it before I moved to Philly. I was looking at it when I was still living up in the Syracuse area. And I thought they wanted too much money for it. And that was a property I was surprised when I told the broker what I was willing to pay for it and sent him the LOI. He called me up on the phone and he screamed at me. You can't buy a property. Nobody in New Jersey is going to sell a property for that kind of a cap. I said, it's nothing personal. You don't need to yell. They never sold it at that price. 2 years later, it came back on the market again for the same price, but the financials had deteriorated somewhat. So now the property was performing even worse than it was the 2 years prior. So if you go out to my YouTube channel, you'll find that I have a video there the second time when I actually toured the property a second time and saw all the problems the first time had not been corrected. And I talked through a little bit of the numbers and how it's even worse, but they still want the same amount of money. I didn't sell the second time either. So next year, 2021, is when it's time to come up again for the third time. And I'll be interested to see what they're going to do with that. It's a 40-unit property out there off the Black Horse Pike, I believe it is. So it's interesting how these things can happen. But yeah, so that's why I keep them, because you never know when they come back on the market. You can go back and you can look at the historical information that you have and make sure they're not trying to pull a fast one on you, with new data. Oh, we have a question here. Okay, no, we don't. Any other questions? We've hit the time limit for when I told you the meeting was going to be. I'm willing to go a little longer if you have any additional comments or questions, but if not, any other comments or questions?
Question.
Yeah.
At the end of the deal, when you return the capital to your investors,
Yep.
are they still in the deal?
Yep.
So at what point, I mean, do they
That's an intention. That's
get
something
out at all?
you can either do that or not do that. And that's something you state up front in your PPM and in your operating agreements and stuff like that. There are some investors out there who would say, when I give you back all your money, you're out of the deal. And I know people who do that. And I also know people say, well, since you allowed me to have the deal, you use your money, you're getting these returns, and I return your money, there's no reason for me to take you out of the deal, because that's your reward for signing up with me in the first place. So there's two schools of thought on that. I tend to be more on the side of, if you were in the deal with me from the beginning, then we're all in it together until the end. But you get to make that choice.
Yeah, but Dennis, the only thing is, on all the PPMs that I write, I basically say that if we have a 70-30 split, just for the sake of discussion, if we buy them out, then the split turns to 70-30.
The other way.
The other way. And the reason for that is because they now have no skin in the game.
Yeah.
But I'm now responsible for the whole chihuahua, as I say, or burrito, or whatever. I forgot the expression.
Enchilada.
Enchilada.
And I'm Polish, okay? So, yeah. But no, yeah. It doesn't mean you can't renegotiate the split. I'm all for renegotiating that split.
Yeah,
and
but if you put it in your PPM immediately, and you tell everybody, if we buy you out, you're still going to be there 30%, because now your return is infinite.